This American has borrowed over $8 billion to buy Bitcoin. $8 billion. His company now owns 630,000 Bitcoin, purchased for roughly $46 billion. And he's turned this into a $114 billion empire. That's larger than most countries' entire economies, built by accumulating digital currency that didn't even exist when I started my career. Now, in any sensible world, borrowing more money than your company is worth to gamble on cryptocurrency should have banks laughing you out of the building faster than you can say risk management. But somehow, Michael Saylor has convinced Wall Street that this isn't just reasonable. It's brilliant corporate strategy. The man has transformed a boring software company called MicroStrategy into what can only be described as the world's largest Bitcoin investment fund disguised as a corporation. And the most maddening part, it's working spectacularly. He's discovered what I can only call the infinite money glitch. It's like finding a cheat code in a video game, except instead of unlimited lives, you get unlimited borrowing capacity to buy digital assets that have made him richer than entire industries. I've spent weeks trying to understand this financial alchemy, and I think I've figured out what Saylor has achieved. He's turned debt into astronomical wealth, using other people's money and cryptocurrency speculation on a scale that defies belief. Now, before I dive into this tale of financial wizardry or madness, do us a favor and hit that subscribe button, because what you're about to hear will make you question everything you thought you knew about corporate finance, prudent risk management, and how some people build empires while others stick to conventional wisdom. The story of how one CEO convinced the entire financial system to fund his Bitcoin obsession is either the greatest corporate strategy ever devised, or the most elaborate financial experiment in modern history. And frankly, I'm still not entirely sure which it is. Let me tell you about MicroStrategy before Michael Saylor went completely mental and decided to bet everything on digital coins. Back in the 1990s, this was actually a legitimate business, a software company that helped corporations make sense of their data. Saylor founded MicroStrategy in 1989, straight out of MIT, with the sort of American confidence that only comes from being genuinely brilliant and completely convinced you can change the world. The company built business intelligence software, essentially sophisticated computer programs that helped corporations analyze their sales data, customer behavior, and market trends. During the dot-com boom, MicroStrategy was flying high. Their software was in massive demand. Their stock price was soaring like a rocket, and Saylor was worth about $7 billion at the peak. $7 billion. That's more money than most small countries generate in annual GDP. The company went public in 1998, and for a brief, shining moment, they were the darlings of Wall Street. Investors couldn't get enough of companies that promised to revolutionize how businesses used data and technology. MicroStrategy seemed destined to become one of the defining technology companies of the new millennium. But then reality came crashing down with the spectacular force that only burst bubbles can deliver. The dot-com crash of 2001 hit technology companies like a sledgehammer, and MicroStrategy's stock price fell off a cliff faster than investor confidence in internet businesses. Suddenly, Saylor wasn't a billionaire anymore. The company that had been worth tens of billions was worth a fraction of that overnight. They had to lay off employees, scale back ambitious expansion plans, and do what every sensible business does during tough times: focus on actually making money from actual customers rather than living off investor hype. For the next 20 years, MicroStrategy became exactly what you'd expect from a mature software company: steady, profitable, but decidedly unsexy. They sold business intelligence tools to corporations that needed to analyze their data, generated consistent revenue, and kept shareholders reasonably satisfied with modest but reliable returns. The company survived the dot-com crash, weathered the 2008 financial crisis, and by 2020 had established itself as a solid, if unremarkable, player in the enterprise software market. They had loyal customers, predictable cash flows, and a business model that worked reliably year after year. But here's the thing about Michael Saylor. The man wasn't built for boring predictability. He'd experienced what it was like to be worth billions, to be the center of Wall Street attention, to have investors hanging on his every word. Running a steady software company was like asking a Formula One driver to deliver pizzas. By 2020, MicroStrategy was sitting on approximately $500 million in cash and short-term investments, earning essentially nothing in bank accounts while generating modest but consistent profits from their software business. In any normal corporate world, this would be considered responsible financial management and reasonable success. But Saylor looked at his balance sheet and saw something that would drive any ambitious entrepreneur absolutely mental. All that money just sitting there, earning practically zero interest, while inflation slowly eroded its purchasing power. For someone who had once commanded billions in market value, watching cash lose value was unbearable. March 2020 hit the global economy like a meteorite, and while most people were figuring out what social distancing meant, Michael Saylor was having an epiphany that would eventually reshape corporate finance. The COVID pandemic triggered the most aggressive monetary response in modern history. Central banks worldwide started printing money at unprecedented rates. Governments launched massive stimulus programs, and interest rates dropped to essentially zero across developed economies. For most corporate treasurers, this created a frustrating but manageable problem. Their cash reserves were earning practically nothing, but at least the money was safe. The conventional wisdom was to accept low returns as the price of financial prudence and focus on running the core business. But Saylor looked at MicroStrategy's $500 million treasury and realized he faced an existential problem. With interest rates at zero and central banks creating trillions of new dollars, that cash wasn't just earning nothing, it was actively losing purchasing power every single day. Think about the mathematics. You're holding hundreds of millions of dollars that are supposed to be your company's financial foundation. But monetary policy is systematically reducing their real value. It's like storing food in a warehouse where everything slowly rots, except the rot is invisible and happens gradually. Most CEOs would have shrugged, accepted this as an unfortunate reality of the economic environment, and focused on operational improvements to offset the impact. But Saylor started studying monetary policy with the intensity of an academic researcher. He dove deep into the history of currency debasement, analyzed the long-term effects of quantitative easing, and studied what happens when governments finance massive spending through money creation. The more he learned, the more convinced he became that holding dollars was financial suicide in slow motion. That's when Bitcoin entered his worldview. Saylor had largely dismissed cryptocurrency for years, considering it either a speculative bubble or a toy for technology enthusiasts with too much spare time. But suddenly, faced with the prospect of watching his company's cash lose value systematically, Bitcoin started looking like something entirely different. The core logic was elegantly simple. Bitcoin has a mathematically fixed supply of 21 million coins. No government can print more Bitcoin when they need to finance spending. No central banker can decide to increase the money supply for economic stimulus. Therefore, as traditional currencies lose purchasing power through inflation and monetary expansion, Bitcoin should theoretically maintain or increase its value. In August 2020, Saylor made his first move into uncharted corporate territory. MicroStrategy announced they were purchasing $250 million worth of Bitcoin as their primary treasury reserve asset, not as a speculative investment, but as a superior store of value compared to cash. Wall Street's reaction was predictable confusion mixed with skepticism. Software companies were supposed to focus on developing software, not gambling their cash reserves on volatile cryptocurrency. Industry analysts couldn't determine whether this was innovative financial management or corporate recklessness disguised as strategy. But here's where Saylor's timing proved either incredibly lucky or genuinely prescient. Bitcoin's price started climbing dramatically. That $250 million investment quickly became worth $300 million, then $400 million, generating more profit in months than the software division had produced in entire years. The taste of success was intoxicating. Saylor had discovered something most CEOs only dream about: a way to generate massive returns without improving products, acquiring customers, or expanding operations. Why focus on incremental software sales when you could multiply shareholder value through treasury management? That first Bitcoin purchase wasn't just a financial decision. It was the moment Michael Saylor discovered what would become known as the infinite money glitch, a strategy that would transform his company and challenge everything Wall Street understood about corporate risk management.
So first off, for the MicroStrategies, what's been interesting is, so the whole idea here, in case you've been under a rock and you haven't seen what's going on with MSTR, the stock has just been parabolic, but correlated with the US dollar.
What happened next was either a masterclass in financial innovation or the most fortuitous accident in corporate history, depending on your perspective about market timing and entrepreneurial genius. Bitcoin didn't just appreciate after MicroStrategy's initial purchase. It went absolutely mental. From August 2020 through early 2021, Bitcoin's price more than tripled, turning Saylor's $250 million treasury decision into the most profitable corporate strategy of the year. But here's where Saylor's approach becomes truly interesting from a strategic perspective. Most conservative CEOs would have declared victory, sold some Bitcoin to lock in profits, and returned to focusing on their core software business with a nice windfall to show shareholders. Saylor looked at those gains and saw something entirely different. Proof that he had discovered a fundamentally superior approach to corporate capital allocation. The cryptocurrency appreciation wasn't just luck, it was validation of a macroeconomic thesis about monetary debasement and alternative stores of value. The stock market began to notice this transformation. MicroStrategy's share price started moving in direct correlation with Bitcoin's performance. When cryptocurrency prices rose, MicroStrategy shares followed. When Bitcoin declined, the stock declined proportionally. This created an interesting dynamic that most traditional investors had never encountered. A publicly traded software company whose market valuation was increasingly determined by cryptocurrency holdings rather than business operations. For institutional investors who wanted Bitcoin exposure but couldn't buy cryptocurrency directly due to regulatory restrictions or internal policies, MicroStrategy shares became a perfect proxy. They could gain indirect access to Bitcoin price movements through a regulated, audited, publicly traded company. But Saylor saw something even more profound in this market recognition. If investors were willing to value MicroStrategy based on its Bitcoin holdings, and if Bitcoin was going to continue appreciating as governments expanded money supplies, then the logical strategy was to acquire more Bitcoin. Much more Bitcoin. Here's where the story gets properly innovative. MicroStrategy had already spent most of their available cash on that initial purchase. To buy additional Bitcoin, Saylor needed to raise capital, and that's when he discovered the financial engineering approach that would define his strategy. Corporate finance offers several mechanisms for raising money: equity issuance, traditional debt, or hybrid securities like convertible bonds. Each option has different costs, risks, and implications for shareholder value. Saylor realized that MicroStrategy's Bitcoin-driven stock appreciation had dramatically increased their access to capital markets. He could use the paper wealth created by cryptocurrency gains as collateral to borrow substantial amounts of money for additional Bitcoin purchases. In December 2020, MicroStrategy issued their first convertible bonds specifically designed to fund Bitcoin acquisition. They raised $650 million by offering investors either regular interest payments or the option to convert bonds into MicroStrategy stock if the share price appreciated sufficiently. The structure was brilliant in its simplicity. Use Bitcoin-driven stock gains to justify borrowing. Use borrowed money to buy more Bitcoin, which would drive stock prices higher, creating more borrowing capacity for even larger Bitcoin purchases. Saylor had discovered the corporate equivalent of a perpetual motion machine, powered by cryptocurrency appreciation and institutional investors' money. The only question was whether this infinite money glitch would create unprecedented wealth or destroy the company in spectacular fashion. Early results strongly suggested the former. That second major Bitcoin purchase pushed MicroStrategy's total cryptocurrency holdings above $1 billion. The stock price continued climbing, and investors began believing that this software CEO had genuinely discovered something revolutionary in corporate finance. Now here's where this story becomes truly fascinating from a financial markets perspective, because traditional institutions should have taken one look at MicroStrategy's strategy and rejected it as speculative madness. After all, this was a software company that had abandoned conservative treasury management in favor of leveraged cryptocurrency speculation. By every conventional metric, this should have triggered credit downgrades, loan rejections, and institutional investor flight. Instead, something remarkable happened. Wall Street started competing to lend Michael Saylor money faster than he could spend it on Bitcoin. The key to understanding this apparent contradiction lies in how convertible bonds function as financial instruments. When MicroStrategy issues convertible debt, they're creating hybrid securities that offer investors multiple ways to profit. If MicroStrategy's stock price remains stable or declines, bondholders receive steady interest payments like traditional corporate debt. But if the stock price rises significantly due to Bitcoin appreciation, they can convert their bonds into shares and participate in the upside. From an investor's perspective, convertible bonds offer downside protection with upside participation. You get paid whether the strategy succeeds or fails, but you can also benefit from spectacular success. Banks found this structure incredibly attractive for several reasons. They earned substantial fees arranging these complex transactions, attracted clients who desperately wanted cryptocurrency exposure, and faced limited risk since MicroStrategy owed the money regardless of Bitcoin's performance. But the real genius of Saylor's approach was recognizing a massive structural need in institutional markets. Pension funds, insurance companies, and asset managers were under enormous pressure to find Bitcoin exposure for their portfolios. But regulatory restrictions and internal policies prevented direct cryptocurrency purchases. MicroStrategy solved this problem elegantly. Institutions could buy MicroStrategy bonds or shares and achieve indirect Bitcoin exposure through a properly regulated, publicly traded company with audited financial statements and traditional corporate governance. This created extraordinary demand for anything MicroStrategy offered. Their convertible bond issues were consistently oversubscribed, meaning far more investors wanted to buy them than securities were available. Banks competed aggressively to arrange increasingly large financing rounds. Between 2020 and 2025, MicroStrategy raised over $8 billion through various debt instruments, all specifically earmarked for Bitcoin purchases. Each successful fundraising validated their strategy and made subsequent rounds easier to arrange at better terms. The feedback loop was working exactly as Saylor had envisioned. Bitcoin appreciation drove stock prices higher. Elevated stock prices created increased borrowing capacity. Additional borrowing enabled larger Bitcoin purchases, and larger cryptocurrency holdings attracted more institutional interest. But here's what should have concerned traditional risk managers. MicroStrategy was becoming massively leveraged to Bitcoin price movements on an unprecedented scale. They weren't simply holding cryptocurrency as a treasury asset. They were borrowing billions to speculate on digital currency. Yet Wall Street seemed convinced that Bitcoin represented a one-way bet, and that Saylor had discovered a virtually risk-free method for generating infinite returns. Traditional credit analysis appeared inadequate for evaluating a company whose value depended entirely on cryptocurrency appreciation. Banks continued lending, institutional investors kept buying, and Saylor kept borrowing more money to purchase more Bitcoin. The infinite money glitch was functioning perfectly, creating a self-reinforcing cycle of debt, speculation, and wealth creation that challenged every assumption about prudent corporate finance. Somewhere during this process, Michael Saylor underwent a remarkable personal and professional transformation that was both fascinating and slightly concerning to observe. Saylor didn't just buy Bitcoin. He became cryptocurrency's most articulate and passionate corporate advocate. His Twitter account transformed into a non-stop educational platform about Bitcoin's monetary properties, featuring laser eyes, profile pictures, and philosophical proclamations about digital scarcity.
The first was $500 million, $500 million, $1 billion, and this is the largest IPO of the year, $2.5 billion.
Like the tie, do you have, are they all orange now? Mostly?
We only wear orange ties.
You only wear orange ties? Because I went to DC and didn't think about it and wore an orange tie. Every single person.
He began delivering presentations at corporate finance conferences that had nothing to do with business intelligence software and everything to do with Bitcoin's role as a superior store of value. These weren't casual mentions of MicroStrategy's treasury strategy. They were comprehensive educational seminars about monetary history, inflation, and cryptocurrency economics. Saylor would spend hours explaining why traditional currencies inevitably lose purchasing power, why Bitcoin's fixed supply makes it superior to government-issued money, and why every rational corporation should immediately convert their cash reserves to cryptocurrency. His presentations included detailed historical analysis, economic theory, and compelling arguments about monetary debasement. The transformation was so complete that industry observers began referring to MicroStrategy not as a software company, but as Michael Saylor's Bitcoin company. Conference organizers invited him specifically to discuss corporate cryptocurrency adoption rather than technology trends. This evangelism wasn't merely personal passion. It became integral to MicroStrategy's business model. Every time Saylor promoted Bitcoin publicly, he was effectively marketing MicroStrategy as the premier institutional vehicle for cryptocurrency exposure. Other corporate executives began adopting similar approaches. Tesla purchased $1.5 billion in Bitcoin. Square added cryptocurrency to their balance sheet, and several smaller companies announced Bitcoin strategies, all citing MicroStrategy as proof that corporate crypto adoption was both feasible and prudent. Saylor had created a network effect where his success encouraged other companies to pursue similar strategies, which validated Bitcoin as a legitimate corporate treasury asset, which attracted more institutional interest, which drove cryptocurrency prices higher, making MicroStrategy's approach appear even more successful. The software business, the actual company that generated revenue from customers, became increasingly irrelevant to MicroStrategy's overall valuation. Earnings calls focused more on Bitcoin acquisition strategies than software sales metrics. Financial analysts needed cryptocurrency expertise to evaluate the investment thesis. But this evangelism also created significant dependency. MicroStrategy's continued success became tied not just to Bitcoin's price performance, but to Saylor's credibility as cryptocurrency's corporate spokesperson. If investors lost confidence in his vision, the entire strategy could unravel rapidly. Saylor had successfully transformed a predictable software company into the world's most leveraged Bitcoin investment vehicle, wrapped in corporate legitimacy and funded by traditional financial institutions. Whether this represented brilliant strategic innovation or elaborate financial engineering disguised as business strategy would depend entirely on Bitcoin's long-term performance. The distinction between visionary leadership and speculative recklessness would become crucial when cryptocurrency markets experienced their next major downturn. Let me present some numbers that will either impress you with their audacity or terrify you with their implications for corporate risk management. MicroStrategy currently owns approximately 630,000 Bitcoin, purchased for roughly $46 billion over several years of systematic accumulation. The company has a market capitalization of $114 billion, making it one of the world's most valuable corporations by focusing almost entirely on cryptocurrency holdings. They've borrowed over $8 billion through various debt instruments to fund these Bitcoin purchases, creating the most leveraged corporate cryptocurrency position in business history. This isn't conservative treasury management. This is speculation on a scale that dwarfs most hedge funds. The debt structure includes multiple series of convertible bonds with different interest rates, maturity dates, and conversion terms. Some bonds pay minimal interest, as low as 0%. Others offer higher rates, but all depend fundamentally on Bitcoin maintaining or increasing its value over time. Here's where the mathematics become truly staggering. If Bitcoin's price declines significantly, MicroStrategy could theoretically face margin calls or liquidity pressures on their borrowing arrangements. While exact liquidation prices aren't publicly disclosed, significant cryptocurrency declines could force asset sales to meet debt obligations. This creates the potential for what financial experts call a death spiral scenario. Forced Bitcoin selling could drive prices lower, triggering additional margin calls and more forced selling, creating a cascading effect that amplifies market volatility. The risk management approach is unconventional by any traditional corporate standard. MicroStrategy's primary risk mitigation strategy appears to be macroeconomic analysis. Bitcoin will appreciate because governments continue expanding money supplies, making cryptocurrency a superior long-term store of value. Traditional corporate treasurers manage risk through diversification, liquidity management, and ensuring debt service capabilities under adverse scenarios. Saylor has done the opposite, concentrated everything in a single volatile asset and borrowed money to increase that concentration dramatically. The company's software business generates approximately $500 million in annual revenue, but this has become almost irrelevant compared to Bitcoin holdings that determine overall market valuation. The traditional business barely covers debt service costs, let alone provides meaningful financial cushion. Most notably, MicroStrategy has no conventional exit strategy. Saylor has stated repeatedly that the company will never sell Bitcoin regardless of price appreciation, viewing cryptocurrency as permanent treasury assets rather than tradable investments. This philosophical commitment sounds principled until you consider the practical implications. The company has no plan for debt repayment that doesn't depend on Bitcoin's continued appreciation or their ability to refinance obligations indefinitely. Yet somehow, this strategy has functioned successfully for years. Bitcoin holdings have generally appreciated faster than debt service costs, creating paper profits that justify continued borrowing and validate the overall approach. The infinite money glitch continues generating positive returns, at least theoretically. But MicroStrategy's wealth exists primarily as unrealized gains on cryptocurrency that could disappear rapidly during adverse market conditions. The company has constructed an enormous financial edifice that remains stable only as long as Bitcoin continues appreciating. Whether this represents sophisticated risk management or elaborate speculation funded by institutional capital depends entirely on cryptocurrency's long-term trajectory. You might reasonably wonder why sophisticated financial institutions continue providing billions to what essentially amounts to a leveraged Bitcoin speculation scheme with corporate characteristics. The answer reveals fascinating insights about modern financial markets and institutional behavior. Investment banks profit from transaction fees rather than investment outcomes. Every MicroStrategy convertible bond issue generates millions in underwriting fees, legal costs, and advisory revenues. Whether those securities ultimately succeed or fail is investors' concern, not the bank's problem. This creates incentive structures where financial institutions are motivated to facilitate increasingly large transactions, regardless of long-term sustainability. Banks earn immediate compensation for arranging deals, while investors bear the consequences of strategic success or failure. For institutional investors, MicroStrategy represents something more valuable than simple Bitcoin exposure: regulatory arbitrage at scale. Many pension funds, insurance companies, and asset managers face legal restrictions preventing direct cryptocurrency purchases, but they can buy securities from regulated public companies.
It's often referred to online as the infinite money glitch.
See, the misnomer there is it's not a money glitch. It is a digital transformation of the capital markets.
MicroStrategy became the world's largest Bitcoin ETF before Bitcoin ETFs were legally permitted, providing institutional investors with indirect cryptocurrency access through traditional securities markets. This regulatory gap created structural demand for MicroStrategy offerings that transcended normal investment evaluation. Fund managers who had been requesting Bitcoin exposure for years could finally achieve their objectives through MicroStrategy securities, creating captive demand for whatever the company offered. The convertible bond structure enhanced this appeal significantly. Conservative investors could purchase bonds offering steady interest payments while maintaining exposure to potential Bitcoin-driven appreciation. Aggressive investors could benefit from leveraged cryptocurrency exposure through a regulated corporate vehicle. But perhaps most importantly, nobody wanted to appear ignorant about cryptocurrency's potential by questioning the strategy's sustainability. As long as Bitcoin kept appreciating and MicroStrategy generated positive returns, skepticism appeared outdated or unsophisticated. Financial media contributed to this dynamic by treating Saylor as a visionary rather than a speculator. Articles praised innovative treasury management and forward-thinking monetary policy, rather than examining fundamental risks or questioning long-term viability. Credit rating agencies struggled to evaluate companies whose creditworthiness depended entirely on volatile asset prices rather than business fundamentals. Traditional analytical frameworks became inadequate for assessing entities whose value existed primarily as unrealized cryptocurrency gains. Analyst coverage focused on Bitcoin price targets and conversion scenarios, rather than examining what might happen during extended cryptocurrency bear markets. The entire financial ecosystem became invested in MicroStrategy's continued success, both literally and professionally. Everyone involved had incentives to maintain the system's functionality. Banks earned fees. Investors achieved otherwise unavailable crypto exposure. And Saylor managed billions while being praised as a financial innovator rather than a speculator. This self-reinforcing cycle created conditions where MicroStrategy's access to capital depended on Bitcoin appreciation, which depended on continued institutional adoption, which depended on companies like MicroStrategy proving corporate cryptocurrency strategies could succeed. The infinite money glitch functioned because all participants had reasons to believe in its sustainability, even if privately they harbored concerns about long-term risks or market sustainability. The first serious examination of MicroStrategy's infinite money glitch came during 2022's cryptocurrency market collapse, when Bitcoin experienced one of its most severe price declines in history. Bitcoin fell from approximately $69,000 to below $16,000, a decline of more than 75% that devastated cryptocurrency markets and tested every assumption underlying leveraged crypto strategies. For MicroStrategy, this wasn't simply an investment loss. It was an existential crisis that challenged the fundamental viability of their entire business model. The company's stock price declined even more dramatically than Bitcoin itself, falling over 80% from peak values and eliminating hundreds of billions in market capitalization. Convertible bonds that had seemed attractive during rising markets suddenly looked much less appealing to investors. MicroStrategy faced potential margin pressures on some borrowing arrangements, creating scenarios where they might need to post additional collateral or consider selling Bitcoin to meet debt obligations. For a company whose strategy was based on never selling cryptocurrency, this created impossible choices. Saylor's response demonstrated either remarkable conviction or dangerous stubbornness, depending on your perspective. Instead of acknowledging that leveraged cryptocurrency speculation might carry unsustainable risks, he used the price decline as an opportunity to acquire additional Bitcoin at lower prices. The company continued issuing debt, found creative financing mechanisms, and actually increased their Bitcoin purchases during the market crash. Saylor argued that cryptocurrency's decline proved it was undervalued rather than indicating flaws in the strategy. This required extraordinary confidence about Bitcoin's long-term prospects. While other cryptocurrency investors were reducing exposure and cutting losses, MicroStrategy was borrowing more money to increase their position in an asset, demonstrating spectacular volatility. The 2022 experience revealed how precarious MicroStrategy's financial structure had become. Debt service costs exceeded software revenue, meaning the company was entirely dependent on Bitcoin appreciation for financial viability. Several convertible bond issues approached potential liquidation scenarios, requiring complex financial engineering to maintain adequate collateral ratios and avoid forced asset sales. The company restructured existing obligations, found alternative funding sources, and employed sophisticated techniques to navigate the crisis. Yet somehow, MicroStrategy not only survived, but emerged in stronger position. Bitcoin's price eventually recovered, stock prices followed, and by 2025, the strategy was again generating paper profits that validated the decision to increase holdings during the downturn. The experience provided crucial insights about the infinite money glitch's characteristics. It functions brilliantly during favorable market conditions, but requires enormous conviction and sophisticated financial management during adverse periods. Saylor had constructed a financial machine that generates spectacular wealth during cryptocurrency bull markets, but demands increasingly complex solutions to survive extended bear markets without destroying shareholder value. The 2022 crash proved MicroStrategy could survive severe Bitcoin declines, but only through financial engineering that made the overall strategy even more leveraged and dependent on continued cryptocurrency appreciation. Whether this represents resilience or increasing fragility depends entirely on your assessment of Bitcoin's long-term prospects and the sustainability of current monetary policies. Whether Michael Saylor proves to be a genius or completely mental, his Bitcoin strategy has fundamentally altered how corporations think about treasury management and alternative investments. Before MicroStrategy, corporate cryptocurrency adoption was considered so impractical that serious financial professionals didn't discuss it. Corporate treasurers focused on capital preservation through conservative investments, not speculative appreciation in volatile digital assets. Saylor demonstrated that corporate Bitcoin strategies could generate extraordinary shareholder returns and create entirely new categories of corporate value. This proof of concept encouraged other companies to explore similar approaches, validating strategies that seemed impossible just years earlier. Tesla purchased $1.5 billion in Bitcoin before eventually selling most holdings. Block added substantial cryptocurrency positions to their balance sheet. Various smaller companies adopted modified versions of MicroStrategy's approach, though none achieved similar scale or commitment. More significantly, MicroStrategy helped legitimize Bitcoin as an institutional asset class rather than speculative curiosity. When a publicly traded company could borrow billions for cryptocurrency purchases while maintaining investment-grade credit ratings, it signaled Bitcoin's evolution toward mainstream acceptance. The strategy demonstrated how sophisticated corporate finance could amplify returns from alternative investments through convertible securities, stock appreciation mechanics, and leveraged purchasing that generated outcomes far beyond simple cryptocurrency ownership. Traditional asset managers began offering Bitcoin exposure to institutional clients previously prohibited from direct cryptocurrency investment. MicroStrategy's success proved substantial demand existed for Bitcoin-linked securities among conservative institutional investors. But Saylor's approach also raised uncomfortable questions about corporate governance and fiduciary responsibility. Occurred without explicit shareholder approval for such radical business model changes. Investors who purchased shares for software exposure found themselves holding leveraged cryptocurrency positions instead. This precedent could encourage other management teams to pursue similar strategies in different asset classes. Why focus on operational improvements when financial engineering might generate superior returns through alternative investments? The broader implications extend beyond individual companies to systemic financial stability. If corporate treasury management becomes focused on speculation rather than preservation, what happens during major financial crises when multiple leveraged companies face simultaneous pressures? MicroStrategy's approach works brilliantly during favorable conditions, but creates systemic risks absent when companies maintained cash in stable government securities and bank deposits. Regulators are beginning to notice these developments, proposing enhanced disclosure requirements and risk management standards for companies with significant cryptocurrency positions. The era of unlimited corporate Bitcoin speculation may face increasing restrictions, but currently, Saylor's strategy continues inspiring imitators worldwide. Other companies are exploring whether similar approaches could work with different assets, real estate, commodities, or alternative investments, providing inflation protection and appreciation potential. The infinite money glitch that began with one CEO's frustration about zero interest rates has evolved into a broader movement, potentially reshaping corporate finance permanently. As of mid-2025, MicroStrategy's position represents both the ultimate vindication of Saylor's strategy and its greatest vulnerability, creating a fascinating study in corporate risk management and market dynamics. The company owns more Bitcoin than most nation-states, has demonstrated that corporate cryptocurrency strategies can survive major market downturns, and continues attracting institutional investment from traditional financial institutions seeking cryptocurrency exposure. Their Bitcoin holdings are worth substantially more than the original $46 billion cost basis, representing unrealized gains that have created one of the world's most valuable companies through pure financial engineering rather than operational improvements. But those spectacular gains come with over $8 billion in debt obligations secured by cryptocurrency holdings that could lose significant value rapidly during adverse market conditions. MicroStrategy now trades like a leveraged Bitcoin fund rather than a technology company. Recent regulatory developments have created both opportunities and challenges. Bitcoin ETF approvals provided alternative institutional cryptocurrency access, potentially reducing unique demand for MicroStrategy securities as proxy investments. Simultaneously, growing institutional Bitcoin acceptance has validated Saylor's fundamental thesis that cryptocurrency represents legitimate corporate treasury assets. Major financial institutions now offer Bitcoin custody services, and regulatory frameworks increasingly support institutional cryptocurrency adoption. MicroStrategy's success has inspired international copycats. Japanese company MetaPlanet announced their own corporate Bitcoin strategy with different financial engineering approaches, while other companies explore whether similar strategies could work with alternative assets or different regulatory environments. The basic concept of using leveraged corporate finance to amplify returns from appreciating assets has applications extending far beyond cryptocurrency markets, potentially influencing how companies approach treasury management generally. But significant challenges remain that could test the strategy's long-term viability. Bitcoin's volatility hasn't decreased meaningfully, while MicroStrategy's leverage has increased, creating potentially explosive combinations during severe market downturns. Interest rate changes could significantly affect the economics. Rising rates increase debt service costs, while potentially reducing institutional demand for alternative investments like Bitcoin that generate no current income. Perhaps most concerning is the complete lack of diversification in investment holdings or management approach. Saylor's vision drives every major decision, with no clear succession planning, if something happens to the cryptocurrency evangelist who created this financial structure. After extensive analysis of MicroStrategy's strategy, financial engineering, and market performance, I've reached a conclusion that defies simple categorization. Michael Saylor is simultaneously completely mental and potentially brilliant, often within the same strategic decision. The genius aspects are genuinely impressive and undeniable. Saylor identified a legitimate macroeconomic problem: central bank policies that systematically punish cash holders through inflation and zero interest rates, and developed an innovative solution that generated extraordinary returns for shareholders willing to accept associated risks.
Okay, what are people missing about Bitcoin, and what are they missing about strategy?
Using convertible bonds to fund massive cryptocurrency purchases while maintaining access to capital markets required navigating complex regulatory environments that would challenge experienced corporate treasurers. Saylor also exhibited remarkable conviction and persistence when Bitcoin crashed severely in 2022 and critics declared the strategy failed. He doubled down rather than capitulating, using declines to accumulate additional cryptocurrency at lower prices. That conviction ultimately proved correct as markets recovered, but the apparent madness is equally obvious and concerning. MicroStrategy has borrowed over $8 billion to speculate on assets that didn't exist 15 years ago, whose long-term viability remains unproven despite recent success, raising fundamental questions about whether this represents corporate strategy or speculation funded by public markets. The truth probably lies somewhere between these extremes. Saylor discovered approaches that function exceptionally well under current monetary and market conditions, but may not remain sustainable indefinitely. His timing was extraordinarily fortunate, launching this strategy immediately before the largest cryptocurrency bull market in history created optimal conditions for success. Whether that timing represents genuine insight about macroeconomic trends or remarkable luck remains unclear. The strategy benefits from unique market conditions that may not persist. Ultra-low interest rates made borrowing inexpensive. Institutional Bitcoin adoption created demand for MicroStrategy securities, and favorable regulatory treatment allowed complex structures to function legally. Changes in any underlying conditions could undermine the infinite money glitch's effectiveness. Rising interest rates, cryptocurrency regulations, or shifts in institutional investment preferences could make Saylor's approach less viable or entirely impractical. Perhaps most significantly, the strategy's success has attracted regulatory attention and competitive pressure that didn't exist when MicroStrategy pioneered this approach. The ultimate verdict depends on future developments. If Bitcoin continues appreciating and MicroStrategy successfully refinances debt obligations, Saylor will be remembered as a visionary who revolutionized corporate finance through innovative thinking. If cryptocurrency markets experience extended declines or regulatory changes undermine viability, the same approach will be studied as a cautionary tale about leveraged speculation disguised as treasury management. What's certain is that Saylor created something unprecedented, a publicly traded company whose entire value proposition depends on a single alternative asset that most people still don't fully understand. Whether this represents evolution or aberration in capitalism remains to be determined, but there's no question the infinite money glitch has challenged fundamental assumptions about corporate risk, alternative investments, and the relationship between speculation and legitimate business strategy. So what happens next for Michael Saylor's infinite money glitch? The answer depends on factors largely beyond MicroStrategy's control, making this one of the most fascinating experiments in modern corporate finance. Bitcoin's long-term trajectory will ultimately determine whether Saylor's strategy represents genius or elaborate folly. If cryptocurrency continues gaining institutional acceptance and governments continue expanding money supplies, MicroStrategy's approach could generate wealth on scales that make current returns seem modest. The company could become the blueprint for corporate treasury management in an era of monetary debasement, inspiring widespread adoption of similar strategies across various industries and asset classes.
And I've told boardrooms and companies and CEOs why they need Bitcoin. And I've spoken to the disembodied spirits about why our children's children need Bitcoin. But my presentation today is directed at the 8 billion people on the planet.
But if Bitcoin faces sustained declines, regulatory restrictions, or technological obsolescence, MicroStrategy's leveraged position could prove catastrophic. The same financial engineering that amplified gains would accelerate losses, potentially destroying shareholder value rapidly. Regulatory developments pose another crucial variable. Governments might impose restrictions on corporate cryptocurrency holdings, limit convertible bond structures, or require enhanced risk disclosures that make similar strategies less attractive. Interest rate normalization could significantly impact the economics, Higher borrowing costs would make debt service more expensive, while potentially reducing institutional appetite for alternative investments that generate no current income. Competitive pressures are also evolving. Bitcoin ETFs now provide direct institutional cryptocurrency access, potentially reducing demand for MicroStrategy securities as proxy investments. Other companies pursuing similar strategies could dilute MicroStrategy's unique positioning. Perhaps most importantly, succession planning remains unclear. Saylor's vision and credibility drive every aspect of the strategy. Whether MicroStrategy could maintain this approach without its crypto-evangelical founder remains questionable. The infinite money glitch functions because markets believe in its sustainability and Saylor's ability to execute the strategy successfully. If either assumption proves incorrect, the entire structure could unravel rapidly. Yet for now, the experiment continues producing results that validate Saylor's confidence and attract institutional support. MicroStrategy has created something genuinely unprecedented in corporate finance, with implications extending far beyond a single company's Bitcoin holdings. Whether future business schools will teach this as innovative strategy or spectacular speculation depends entirely on how the story concludes. But regardless of ultimate outcomes, Saylor has already proven that sometimes the most outrageous approaches work better than conventional wisdom suggests. The infinite money glitch has rewritten rules about corporate finance, institutional investment, and the relationship between speculation and legitimate business strategy. Whatever happens next, MicroStrategy's experiment will provide valuable lessons about the limits of financial engineering and the power of conviction in uncertain markets. So there you have it, the extraordinary story of how Michael Saylor discovered the infinite money glitch and convinced Wall Street to fund his Bitcoin obsession to the tune of over $8 billion, transforming it into a $114 billion empire that challenges every assumption about corporate finance. What began as one frustrated CEO's response to zero interest rates became a corporate finance revolution that questioned fundamental assumptions about treasury management, risk control, and fiduciary responsibility. Saylor proved that sometimes the most outrageous strategies work spectacularly better than conventional approaches. The man transformed a forgotten software company into the world's most leveraged Bitcoin investment vehicle, while maintaining investment-grade credit ratings and attracting institutional investors who should have recognized the risks but couldn't resist the potential returns. But here's what makes this story particularly significant. Saylor didn't just discover a method for profiting from cryptocurrency speculation. He created a template that companies worldwide are attempting to replicate, proving that financial innovation often comes from those willing to completely ignore established wisdom. The infinite money glitch has become something of a holy grail in modern corporate finance, a mechanism for generating spectacular returns without improving underlying business operations. Why focus on incremental software sales when you can borrow billions to acquire digital assets that might appreciate dramatically? Whether this represents genuine financial innovation or elaborate speculation disguised as corporate strategy remains hotly debated. What's undeniable is that MicroStrategy has rewritten rules about what public companies can accomplish through sophisticated financial engineering and institutional capital. The broader implications extend far beyond Bitcoin accumulation. Saylor demonstrated that corporate treasuries can become massive profit centers rather than conservative cost centers, that alternative investments can completely replace traditional cash management, and that Wall Street will fund virtually anything if projected returns appear attractive enough. But every financial innovation carries risks that become apparent only when market conditions change dramatically. The infinite money glitch functions brilliantly during cryptocurrency bull markets, but could prove catastrophic during extended bear markets. The distinction between genius and madness often depends on timing, market conditions, and factors beyond any company's control. Saylor's success required extraordinary circumstances that may not persist indefinitely. As I complete this analysis, MicroStrategy continues generating returns that justify their strategy, at least based on current valuations. Banks keep lending enormous sums, investors keep purchasing their securities, and Saylor keeps evangelizing about Bitcoin's inevitable dominance over traditional currencies. The story remains unfinished. MicroStrategy's ultimate success or failure will provide crucial lessons about the limits of corporate financial engineering and the sustainability of leveraged alternative investment strategies at unprecedented scales. But perhaps the most important insight from Saylor's experiment is that in modern finance, conventional wisdom isn't always correct, and sometimes the most ridiculous strategies produce the most remarkable results. Whether future generations will study this as brilliant innovation or spectacular speculation depends entirely on what happens next in cryptocurrency markets, regulatory environments, and global monetary policy. Now, whilst I've been studying this corporate finance revolution from my desk, you might think Saylor's the only CEO audacious enough to attempt this infinite money glitch approach. Well, you'd be mistaken. There's a Japanese company called MetaPlanet that's decided to copy this strategy with their own unique modifications. And let me tell you, what they're attempting makes even less sense than MicroStrategy's approach, if such a thing is possible. They've taken Saylor's template and somehow made it even more leveraged, more speculative, and more dependent on cryptocurrency markets that nobody can predict reliably. So hit that subscribe button, because next week we're examining how a completely different company in an entirely different regulatory environment decided that borrowing money to buy Bitcoin was such a brilliant idea that they had to attempt it themselves, with predictably fascinating results that make MicroStrategy's $114 billion transformation look conservative by comparison. The infinite money glitch is spreading internationally, and apparently nobody learned lessons about what happens when everyone believes they've discovered risk-free methods for generating spectacular wealth. This should be absolutely entertaining to observe.